Welcome, hello. I'm Kevin L. Scott. This is the Kevin L. Scott channel. Today we're going to do a recap of what happened with the FOMC meeting. We're going to give you key takeaways. Um, this article is from wellsfargoadvisors.com. I'm going to leave that down in the description below. Uh, Watch some more of my videos. They help me out with my algorithm and learn something. You feel me? Share them and everything. Give me some subscriptions, some subscribers, whatever the case may be. Anyway, let's hop right into this video. Policy announcement. The Federal Open Market Committee, FOMC, or the committee, increased the federal funds rate by 0.25%, 25 basis points, 100 basis points equals 1%, to 4.75 to 5%, continuing with the slower pace set at the February meeting. The FOMC still expects ongoing increases to the federal fund rate and to continue reducing its holdings of Treasury securities, agency debt, and agency mortgage-backed securities in 2023 in accordance with its statement released in May 2022. So we're going to talk about the topic, which is stated reasons, and we're going to get some details on it. Still a part of the article. Recent indicators points to the modest growth in spending and production. Job gains have picked up in recent months while the unemployment rate has remained low. Inflation, however, still remains elevated. We believe the U.S. banking system is sound and resilient. Recent developments are likely to result in tighter credit conditions for households and businesses and to weigh on economic activity, hiring, and inflation. The extent of these effects is uncertain. The committee remains highly attentive to inflation risk. And looking forward, the FOMC anticipates that ongoing increases in the rate target range should be appropriate and that they expect inflation to return to 2% over time. The FOMC is taking into account the cumulative tightening of monetary policy, the lags with which monetary policy may affect economic activity and inflation, and economic and financial developments. In the past 5 years, in the past five Federal Reserve Fed tightening cycles since 1990, long-term U.S. Treasury yields have peaked before the end of the tightening cycle, but did not begin a clear declining trend until the tightening cycle was over. We acknowledge that, although the current Fed tightening cycle may still not be over, we believe long-term rates have already tested their peak for this cycle and most likely will continue to remain range-bound between 3.5 and 4%. What else? The medium FOMC projection for the terminal federal funds rate during this cycle remains around 5.1%. This is above the long-term neutral rate expectation of 2.5%. The unchanged terminal rate expectation assumes one more 25 basis point rate hike in the first half of 2023. The FOMC median projections increased inflation expectations for this year from 3.1% at the December meeting to 3.3%, while also decreasing the committee's expectation for real economic growth for the year from 0.5% to December to 0.4%. We believe investors may want to consider locking in a portion of their fixed income portfolios at a current yield levels, effectively implementing a barbell strategy by investing into long and short end of the curve. Upcoming meeting schedules: May 3rd, June 14th, July 26th, and September 20th. So you guys just tell me what y'all thought of that. Um, Leave a comment again, leave a like, watch some more of my videos, and subscribe to the page. Share if y'all learn anything and earn something. Thank you.